So last week we launched a brand new show here at Kitco News, Commodities Confidential. It features Jeff Christian. He's the managing director behind CPM Group. It's the renowned research firm that's based in New York. And every week we'll be featuring different analysts from the firm. And today, Erica Ranestad joins me and we'll be looking at the outlook for platinum and palladium in 2013. Erica, thanks for being with me this week.
Pleasure to be here.
So Erica, as I mentioned at the start, last week we had Jeffrey Christian on talking about the outlook for gold in 2013. Today I'm excited to get your perspective on platinum and palladium for the new year. But before we look to the future, I'd like to just look back over at 2012 and get your thoughts on what you think was perhaps a defining moment for platinum and palladium, these two metals, over the course of the year.
Yeah, well, first of all, the platinum group metals had a really interesting year in that the prices of these metals moved in kind of a roller coaster fashion, if you will. And the upswings were really driven by supply shocks in the market in South Africa, and those downswings were driven by investors selling the metal based off of their expectations on fabrication demand over the course of the year and in the medium term, even into forward years. So you had prices moving up, for platinum 20%. In a given upswing driven by the three main strikes that occurred throughout the year, with the strongest occurring in August during the Lonmin strike.
Yes, absolutely. Obviously, South Africa, a crucial focus point for platinum and palladium in 2012. As we head into 2013, do you think the issues there will spill over?
Well, there's still a lot of uncertainty in the PGM markets. There's a lot of issues with regard to how wage settlements are negotiated that are still unresolved and still in the process of being figured out in South Africa. So you still have a lot of uncertainty regarding the flow of supply over the medium term, and that's going to add a lot more price support to these metals. So with that said, I believe that the trading ranges of platinum and palladium will be higher relative to the trading ranges in 2012.
So if we look at platinum first, Erica, what kind of trading range are you expecting for the metal in the new year?
Well, the platinum trading range for this year was mostly between 1380 and 1750. I expect that trading range to increase to around 1450 and 1800. So I'm still very limited on the upside because I think there's still a lot of uncertainty and limitation in terms of fabrication demand growth, but you have a lot more support on the downside because of the uncertainty about supply.
Erica, before we look over at palladium, what is the most important source of demand for platinum?
The driving force is from the auto sector, but you still have a huge component allocated to jewelry, which adds as somewhat of a buffer. So when you see prices coming down, you will see jewelry demand pick up. Jewelry demand is mostly concentrated in China, and that's a growing economy in general. So as those disposable incomes are rising, it is it provides a little bit less of the price sensitivity component and more can be more a function of disposable incomes rising. So overall, I mean, auto demand is important. You have the European component, which is the largest component of auto demand for platinum. And because we're expecting a bit of an improvement in the European economy in the latter half of the year, you could see a little bit more of an improvement on investor expectations for fabrication demand going forward.
Erica, if we look to palladium now, what are you expecting for this metal?
Well, similar to platinum, I do expect the floor price to move higher. So palladium mostly traded between 550 and 725 this year. I expect the range to be around 600 and 800 in 2013. There is more upside to palladium prices if the European economy improves, if the Chinese economy picks up faster relative to 2012, if the the U.S. economy improves as well. There's more upside in those prices because the fabrication demand component is more highly concentrated with the auto sector. So an improvement in auto sales would be more positive for palladium prices than for platinum. So that said, there is a lot of potential for capital appreciation if the European economy turns around in the second half. But the economic expectations are pretty uncertain right now, so we'll see how that goes.
But Erica, why do you say that? Is it because the European market relies more on palladium?
No, not necessarily. So the European auto market, the passenger car market that is about half of it is powered by diesel, while the other half is gasoline powered. So that's the hugest gasoline passenger car market in the world. And the diesel cars still use a lot of platinum, although they have introduced palladium over the past few years, so that has become more important to the palladium market relative to, say, 5 years ago. So while an upswing in European auto sales is actually more positive for platinum demand, it's still very, very positive for palladium demand.
So Erica, now I know you've worked on some interesting cash cost calculations on the PGM market. Do you mind shedding some light on first why it's important to look at cash costs and what some of those numbers might be?
Sure. First off, cash costs is a performance measure used in the mining industry. It's especially important for the platinum group metals because of the very high concentration of supply in South Africa. And South African cash costs have been increasing at a very strong rate over the past decade at about 13% per year since 2000. So recently what I did was I took a look at what I expect output to be in the country and how that could impact cash costs. And what I found was that this year we could see a very, very strong increase year on year in cash costs of PGMs, as much as 25%, mostly as a function of the reduction in output volumes. So cash costs is measured as the price or the cost of mining 1 ounce of platinum group metals. Last year, globally, it was around $570 on a C1 cash cost basis, which is a standardized measure of cash costs. And this year, I see it rising anywhere between 15% and 25%. I expect that the cost of input materials could increase about 7.5 to 8%, and the balance, which is about 2/3 of that 25% increase, would be sheerly a function of the reduction in output volumes. So this is a really important point I wanted to make about my expectations for a higher floor price, because in the long term, rising cash costs does support prices of commodities.
So that's a good point, Erica. So that wouldn't necessarily translate into good news for the producers?
Not necessarily. I mean, this year you're seeing the margins really narrow pretty materially, but it does provide some insight into the marginal cost of production, what is going to be required in terms of prices staying at certain levels or staying above certain levels in order for a certain amount of production to come out, it can help define the amount of output in the longer term.
And just out of curiosity, Erica, when we compare the cash cost of platinum to gold, is it much higher?
No, not necessarily, actually. Mining gold, it costs about, on an annual average basis, it's about $600, $700. And that's kind of in line with the platinum group metals.
Good thoughts from you today, Erica. We hope to see you soon. I appreciate your insights and happy holidays.
Thank you.
And thank you for watching this edition of Commodities Confidential. You can email us any topics you'd like to see covered on the show at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.